Have you ever wondered why? Today we're diving deep into why every country is in debt, who they owe money to, and what this means for the global economy. By the end of this video, you'll understand the mechanics of national debt, its causes, and the key players in the global debt system. Let's start with a simple question. What is national debt? National debt is the total amount a government owes to its creditors. This happens when a government spends more than it earns from taxes and other revenues, creating a budget deficit that needs to be covered by borrowing. Think of it like a credit card for a country. If you spend more than you have, you borrow to cover the difference, and that debt accumulates over time. As of 2025, global debt has reached a staggering $307 trillion, according to the Institute of International Finance. This includes borrowing by governments, businesses, and households, but government debt makes up a significant portion of this figure. In 2022, global public debt alone was $92 trillion, with developing countries accounting for nearly 30% of that total. So why do countries borrow so much? There are several reasons, and they vary depending on the country's economic situation. First, governments borrow to fund essential services like healthcare, education, and infrastructure when tax revenues fall short. For example, building roads, hospitals, or schools requires massive upfront costs that most countries can't cover without loans. Second, emergencies like wars, natural disasters, or pandemics force governments to borrow to cover immediate expenses. The COVID-19 pandemic, for instance, caused a massive spike in global debt as countries funded relief programs and healthcare responses. In the United States, the national debt surged due to stimulus packages during the pandemic, reaching $36.4 trillion by March 2025. Third, economic downturns like recessions reduce tax revenues while increasing the need for social safety nets, pushing governments to borrow more. Finally, some countries borrow to stimulate economic growth, investing in projects that they expect will generate future revenue. Japan, for example, has a debt-to-GDP ratio of over 255%, largely due to decades of borrowing to boost its economy. But who exactly are these countries borrowing from? Let's break it down into the main creditors. First, governments often borrow from their own citizens through domestic bonds like U.S. Treasury securities. These are considered safe investments because they're backed by the government's ability to tax its citizens. In the U.S., about $19.4 trillion of federal debt is held domestically as of December 2023. The Federal Reserve, mutual funds, banks, and individual investors are major domestic holders of this debt. Second, countries borrow from foreign governments and investors, which is known as external debt. As of April 2024, foreign countries own $7.9 trillion of U.S. debt, or about 22.9% of the total. Japan is the largest foreign holder, with $1.9 trillion, followed by China with $768.6 billion. Other major holders include the United Kingdom, Luxembourg, and Canada, each owning hundreds of billions. Foreign investors buy U.S. Treasury securities because they're seen as one of the safest investments in the world. This is because the U.S. government has a strong track record of repaying its debts on time. Third, international institutions like the International Monetary Fund and World Bank lend to countries, especially developing ones. The IMF lending capacity is around $932 billion, often used to help countries facing economic crises. In 2023, developing countries spent a record $1.4 trillion servicing their foreign debt, with interest payments alone at $406 billion. For the poorest countries, interest payments can eat up a huge portion of their export earnings. These loans are often more expensive, with interest rates from private creditors reaching 6% in 2023. This makes borrowing from private sources riskier and harder to manage compared to loans from multilateral institutions. Now let's talk about why debt is such a persistent issue. One key factor is the structure of the global financial system. Developing countries often face higher interest rates than developed ones, even when borrowing from the same sources. This means they pay more to service their debt, leaving less money for essential services like health and education. In 2022, many developing countries spent more on interest payments than on education or healthcare. This creates a vicious cycle where borrowing leads to more borrowing just to cover interest payments. Another issue is the complexity of modern debt. As more countries borrow from private creditors, restructuring debt becomes harder. Unlike loans from multilateral institutions, private debt involves many creditors, making negotiations slow and costly. This can lead to prolonged debt crises where countries struggle to make payments and fall deeper into debt. Exchange rate fluctuations also play a role. When a country borrows in a foreign currency like US dollars, a weaker local currency increases the debt burden. For example, if Brazil borrows in dollars and the Brazilian real weakens, the debt becomes much harder to repay. This is a common problem for developing nations, amplifying their debt challenges. Historical factors also contribute. Some countries inherited debt from colonial eras or past mismanagement. For instance, in 1987, Burkina Faso's President Thomas Sankara called debt a form of neocolonialism, arguing that it kept African nations dependent. He believed creditors used debt to control developing countries, a perspective that still resonates today. Let's look at some specific examples to see how debt varies across countries. The United States has the highest national debt in dollar terms, at $36.4 trillion as of March 2025. However, its debt-to-GDP ratio is 121.31%, which is high but manageable due to its massive economy. Japan, on the other hand, has a debt-to-GDP ratio of 255.7%, one of the highest. Japan's debt is mostly held domestically, and its control over the yen makes default unlikely. China's national debt is over $13.7 trillion, but its debt-to-GDP ratio is only 76.98% thanks to its large economy. Russia, by contrast, has a low debt-to-GDP ratio of 18.89%, with a total debt of just under $424 billion. These examples show that debt levels and their impact depend on a country's economic size, currency control, and borrowing strategy. Developing countries like Sri Lanka face unique challenges. In 2022, Sri Lanka's debt crisis led to mass protests that ousted its president. High external debt and reliance on microcredit left citizens struggling to afford basic needs like healthcare and education. This highlights how debt crises disproportionately harm ordinary people, not just governments. So is debt always a bad thing? Not necessarily. When used wisely, debt can drive economic growth and development. Investments in infrastructure or education can generate long-term returns that outweigh the cost of borrowing. For example, borrowing to build a new highway can boost trade and create jobs, increasing tax revenues over time. However, excessive debt can lead to serious problems, like high interest payments that crowd out other spending. In the US, interest payments reached $582.5 billion in 2025, or 16% of federal spending. For poorer countries, high debt can lead to default, economic crises, and reduced spending on critical services. More than half of low-income developing countries are at high risk of debt distress, according to the IMF. This means they may struggle to make debt payments without cutting essential programs or seeking bailouts. The global financial architecture also exacerbates these issues. It often favors wealthier nations with better access to cheap credit. Developing countries, meanwhile, face higher borrowing costs and stricter conditions, making debt harder to manage. This inequality in the financial system perpetuates a cycle of dependency for poorer nations. What can be done to address the global debt problem? There are several strategies countries can pursue. First, improving tax collection can increase revenue, reducing the need to borrow. This is especially important for low-income countries. For example, strengthening tax systems can help governments fund services without relying heavily on loans. Second, governments can prioritize spending on high-return investments to boost economic growth and repay debt. Projects like renewable energy plants or public transportation can create jobs and increase tax revenue over time. Third, debt restructuring or forgiveness can help countries with unsustainable debt levels. The Jubilee 2000 campaign, for example, led to $130 billion of debt cancellation for poor nations. This allowed countries to redirect funds to development instead of interest payments. However, debt relief often comes with conditions like adopting free market policies, which can limit a country's autonomy. Finally, reforming the global financial system to offer fairer terms for developing countries could reduce debt burdens. This might include lower interest rates or more concessional loans from multilateral institutions. International cooperation, like the G20's Common Framework, aims to streamline debt restructuring for low-income countries. However, progress has been slow, and many countries still face crippling debt payments. Another approach is reducing reliance on foreign currency loans to avoid exchange rate risks. Countries with their own currencies, like the US and Japan, have more flexibility to manage debt through monetary policy. For example, the US can print dollars to cover its debts, though this risks inflation if overused. Developing countries without this option often face stricter limits on their borrowing capacity. Some economists propose modern monetary theory, which suggests governments with their own currencies can borrow freely. However, this idea is controversial, as unchecked borrowing could lead to hyperinflation or economic instability. Ultimately, managing debt requires balancing short-term needs with long-term sustainability. Countries must weigh the benefits of borrowing against the risks of accumulating too much debt. In conclusion, national debt is a complex issue that affects every country, from the richest to the poorest. While debt can be a tool for growth, it becomes a problem when it grows too large or is mismanaged. Understanding who countries owe, whether it's their citizens, foreign investors, or international institutions, is key to grasping the global debt puzzle. As global debt continues to rise, finding sustainable solutions will be critical for economic stability worldwide. Debt isn't just a number. It shapes economies, influences policies, and affects the lives of billions. Debt isn't just a number. It shapes economies, influences policies, and affects the lives of billions. Thanks for watching. If you found this video helpful, give it a thumbs up and subscribe for more content like this. Let us know in the comments what you think about global debt or any other topics you'd like us to cover. See you in the next video.